Hi, this is Chris German from The Apartment Dealer, and welcome to our 2022 mid-year multifamily update. This is where we take a look at January through June, those multifamily properties that have sold in your area of ownership. What are the analytics in terms of the average price per unit, the average cap rate, and a quick refresher on cap rate is if you were to buy a building all cash, what would be your expected rate of return? That's an easy way to understand cap rate. Third, we're going to take a look at, well, what's the highest priced sale that's occurred this year for your area of ownership? That gives us an idea of the ceiling value in your area. And then we're going to take a look at current asking rental rates. Now, you probably have found this video one of two ways. One, you found our video on our YouTube channel, or two, you received a postcard from me alerting you to the fact that this information is available. So if you're coming across our educational content for the first time, I have been an apartment broker for the last 16 years, representing landlords like you in the purchase and sale of multifamily properties. That now amounts to about 300 plus multifamily transactions. For about the last 14 years, I've been conducting landlord education, primarily through our live educational events, most recently through our YouTube platform. But most importantly, I'm an investor like you. I self-manage a portfolio of properties that my wife and I own. And so not only daily am I analyzing market data and analytics on behalf of clients, I am also analyzing that same data to know where is Chris going to place his money, what is going to be my next transaction. So I want to share that with you so that you understand that we have the practical knowledge of not only being involved in a lot of multifamily transactions, but being an investor myself. Now, the analytics that we're going to go through today is not Chris's analytics. We actually pull this information from a company called CoStar. They're a third-party group, no affiliation, and they're actually the nation's leading authority when it comes to analytics in the commercial real estate space. So they have no interest whether you are looking to buy real estate, sell real estate, just hold. In other words, they don't shade the information one way or the other. They simply compile the analytics, sell it to brokers like I, so that we can use that information as we assist our clients. That's where the analytics will come from for the sales information. And then when we switch over to rental rates, primarily two sites. Zillow, where that's the #1 platform today to list rental units that are available, especially here in Southern California. And then Rent-A-Meter, which again offers analytics on what are the average asking rates in a specific area. That's where the information will come from. And with that, let's now dig into the numbers. The Western San Gabriel Valley. Now in this particular corridor, we bring together Alhambra, Arcadia, Monterey Park, Rosemead, San Gabriel, Temple City. Now, Chris, why do you bring these particular cities together? It's for three reasons. Number one, they have about the same tenant base. How do we know? Because they have about the same asking rental rates. And third, property values on average are about the same. That's how we build out, or why we have built out this corridor the way we have. The overall sales volume from January to June of 2022 for this corridor has been $154,367,000. That is a healthy sales rate for the first 6 months of this year. Of those properties that sold, the average price per unit was $394,000, nearly $400,000 per unit. That is a big number for this corridor. And the average cap rate, 3.8%, essentially a 3% cap. That is a very low cap rate. That means property values have been definitely on the high side relative to the income that the buildings were bringing in. Now, with respect to rental rates, you could simply pause the video here, find your city of interest, the unit that you're interested in, or unit type you're interested in here. But to give you some idea, say in Monterey Park, the average asking rate for a studio today is $1,165. A one bedroom, $1,671. A two bedroom, $2,099, and a three bedroom, $2,547. Now I realize if you log on to Zillow, you really won't see a one-bedroom apartment advertised for $1,671, right? Remember, these are averages between Zillow and Rent-A-Meter. So you can essentially round that off and say $1,670 for a one-bedroom. But this gives you an idea of what the current asking rental rates are. And I'm sure for many of you, these rates are much, much higher than what you anticipated. And that's a good sign. For highest sales in this market, right? What's that ceiling? Where have we seen some of the buildings trade, or what are the highest values that we've seen buildings trade at? There was this 15-unit building that sold in Arcadia, sold for $8,560,000. That's $570,000 per unit. That is just a huge price per unit. The investor must have really liked that building, but it only takes one buyer, and that buyer decided this building was worth that much. So $570,000. In Monterey Park, this 5-unit building on Pomelo sold for $1,860,000. That's $372,000 per unit. In Rosemead, this 17-unit building on Hellman sold for $4,650,000, which amounts to $273,529 per unit. Very healthy price here in Rosemead. In San Gabriel, 6 units on Muscatel, $2,520,000. That amounts to $504,000 per unit. Again, another big number, especially when you breach $500,000 per unit. Big number for this property here in San Gabriel. We want to look at vacancy rate and rental rates, right? Why? Because rental income impacts the value, in part, on multifamily properties. Now, at the beginning of this year, we recorded a video where we projected what we thought would be the vacancy rate and the growth rate of rents for this year. For vacancy, we had projected that we would see a 1.8% vacancy in this corridor. As of today, we actually sit at 2.5%, significantly higher than what was projected for this corridor, but at the same time, not too alarming. A healthy average vacancy rate is about 3% or less. We're just about there. So again, nothing to be alarmed about. On a positive note, in terms of rental growth, now we had projected for this corridor that we would see over the course of 2022 a growth rate of 6.3%. Where we sit as of today is 7.4%. Rental rates have really grown in this area. Keep in mind, the highest year on record for rental growth was 2021. For as long as they've been tracking this, we saw rents grow by the fastest rate last year. What was the second year of the highest rate of growth? It actually is projected to be this year. So we still anticipate rental rates to continue on a positive trajectory, especially as interest rates are rising, homes are becoming less and less affordable, meaning there's more tenants, supply and demand, that will drive up our rental rates. The East San Gabriel Valley corridor. Now, in this specific corridor, we bring together Azusa, Baldwin Park, Covina, El Monte, Glendora, Laverne, Monrovia, South El Monte, and West Covina. Why do we bring these particular cities together? Because on average, the tenant base is very similar. Asking rental rates are very similar, and property values are very similar, especially given their geographic location. So that's how we build out this particular corridor. In terms of sales volume, for January through June of 2022, the total sales volume has been $75,284,000, a very healthy first half of the year. And the average price per unit has been $283,696. That's a very aggressive price per unit. That's where we sit so far this year. And then the average cap rate has been 4.43%, meaning the income from these properties that have sold has been relatively low relative to the final sales price. Now, asking rental rates. Here you can simply pause the video, find your city of interest, and take a look at what the average asking rental rate is for a particular unit type. But for example, in the city of Glendora, the average asking rental rate for a studio, $1,425. For a one-bedroom, $1,729. Two-bedroom, $2,288, and a three-bedroom, $2,725. Now, I realize that if you go on Zillow, you won't see a one-bedroom apartment in Glendora marketed for $1,729. These are averages between Zillow and Rent-A-Meter. So you essentially can just round that up and say the average is 1,730 in that area. But I would imagine for many of you, as you're reviewing these asking rental rates, they're much higher than you would have anticipated, and that's a good sign. That tells you that rents are on the upward trajectory. Now let's take a look at some of the highest sales from this corridor to give us an idea of, well, how aggressive have prices been here of late. We have this 5-unit in the city of Azusa over on Virginia, sold for $1.8 million, $360,000 per unit. That is a big number for the city of Azusa. And then here in the city of Baldwin Park, I recently sold this building for an investor. 19 units sold for $4,748,000. That amounted to $249,895 per unit, nearly $250,000. Very big number for the city of Baldwin Park. And like I say, we just sold that building here recently. In Covina, 14 units sold for $3.6 million. That was $257,000 per unit. Not extraordinarily high for Covina, but nonetheless one of the highest sales we've seen in the area this year. Then in El Monte, 6 units on Penmar recently sold for $1,820,000. That's $303,000 per unit. About what we would expect here in the city of El Monte. And then here in Monrovia, I recently just represented a seller. In this particular sale, 5 units sells for $1,810,000 over on Walnut. That amounts to $362,000 per unit. Big number for the city of Monrovia. And in West Covina, 30 units on Fernwood sold for $9 million, $300,000 per unit. Now we want to take a look at vacancy rate and rental growth rate. Why? Because the income that a property brings in has everything to do with how much that property is worth. And at the beginning of this year, you may have seen our video where we projected what we would see, vacancy and rental growth, each corridor that we service. And in the San Gabriel Valley, we had projected 1.8% vacancy rate. We're currently at 2.5%. So vacancy has grown faster than we would have anticipated, but nothing to be alarmed about. A healthy vacancy rate is 3% or less. We're just about there. So again, nothing to be alarmed about. Now for rental growth rate, we had projected we would see 6.3% this year. We actually have now seen 7.4%. Rental rates have grown by 7.4%. That's a significant difference. That tells us rental rates are definitely on the uptick. The 605 corridor. In this particular corridor, we bring together Bellflower, Downey, La Habra, La Mirada, La Puente, Lakewood, Montebello, Norwalk, Paramount, Pico Rivera, and Whittier. Now, Chris, why do you bring together these particular cities? It's for 3 reasons. Number 1, the tenant base on average is about the same, meaning the asking rental rates on average are about the same, and property values are roughly on average about the same. So that's how we build out this particular corridor. Now, for the first 6 months of the year, January to June 2022, the total sales volume that is sold thus far is $171,487,000. That's nearly double some of the other corridors that we have taken a look at. So it's been a very healthy first half of the year for this corridor. The average price per unit, $296,913, essentially almost $300,000 per unit. That is a big number for the 605 corridor. Things are in a positive direction there. And then in terms of the average cap rate for those properties that have sold, 4.11%. That is a very low cap rate, meaning the income that those buildings were collecting that sold was on the low end relative to the final sales price. Now, when it comes to asking rental rates, you can simply pause the video here, find your city of interest and the unit type. These are the average asking rents as of today. For example, in the city of Downey, the average studio asking rent today is $1,466. 1 bedroom, $1,758. 2 bedroom, $2,138. And a 3 bedroom, $2,798. And I also realized that, again, you won't go on Zillow and find a 2 bedroom in Downey listed for $2,138. Again, these are averages between Zillow and Rent-A-Meter, so just keep that in mind. You can just average that off and say the average 2-bedroom in Downey is about $2140 as of today. I would imagine that for many of you, as you take a look at this chart, the rental rates are much higher than what you would have anticipated. That's a good thing. Rental rates have been on their growth, and we're going to take a look at that in here in a second to know just by how much. Now, the highest sale in some of these cities, to give us an idea of how aggressive have prices been this year, first half of the year. This 7-unit recently sold in the city of La Puente sold for $2 million. That's $286,000 per unit. That's a big number for the city of La Puente. In Lakewood, this 5-unit property sold for $1.4 million, $280,000 per unit. Not the highest we've ever seen, but still the highest that we've seen thus far this year for Lakewood. In Montebello, 5 units sold for $1,650,000, $330,000 per unit. That's a big number for the city of Montebello relative to what properties typically sell for on average. And Norwalk, 14 units, sells for $4.2 million, about $300,000 per unit. That is a big number for the city of Norwalk. Here recently in Paramount, 12 units, $3,450,000. That's $287,000 per unit. That is a big number for the city of Paramount. In Whittier, 8 units sells for $2,950,000. That equates to $368,750 per unit. That is a big number for the area of Whittier. Now let's take a look at vacancy rate and rental growth rate. These are important because the income a property collects determines, in part, how much a property is worth. At the beginning of the year, you may have seen our video where we had projections for both vacancy and rental growth rate. At that time, we had projected that vacancy would be at about 1.8% for this particular corridor. Where we are today is 2.5%. So we are slightly higher, but nothing to be alarmed about. A healthy vacancy rate is 3% or less. We're definitely within that realm. So again, nothing to be worried about. In terms of rental growth rate, on a positive note here, we had projected that rental rates would grow by 6.3%. They actually have grown by 7.4%, significantly more. That is positive to note. The 7-10-91 corridor. The cities that we grouped together in this corridor are Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, Southgate. Now, Chris, why have you grouped these particular cities together? Well, it's based on 3 things. Number 1, the tenant base, on average, is about the same within these particular cities. How do we know? Because the asking rents are on average about the same for these particular cities, and values are about the same for these particular cities. That's how we put this particular corridor together. Now, sales volume. In total sales dollars, how much has sold since the beginning of this year when it comes to multifamily properties? That today is at $71,839,000, a very healthy first half of the year. The average price per unit for those buildings that have sold thus far this year is $263,453, and the average cap rate is 4.36%. Now, when it comes to rental rates, you can simply pause the video here, pick your city, find the unit you're most curious about. That'll give you the average asking rent. But for example, in the city of Commerce today, the average studio rents for $1,188, or I should say the average asking rate. Whereas a 2-bedroom in Commerce today is at about $1,800. You move over to Maywood, where a studio is on average $1,217, versus say a 2-bedroom there, $1,762. Now, I realize if you were to look at rental ads, you would not see a 2-bedroom being advertised for $1,762. Keep in mind, these are just averages between Zillow and Rent-A-Meter, and so you can just average that off and say it's $1,760 when you go to place your next ad. But I would imagine for many of you, these rental rates are much, much higher than what you were anticipating. Now, when it comes to some of the highest sales in this corridor, first we'll take a look at this 11-unit building that's sold in the city of Bell. This particular property sold for $363,000 per unit. That's a very big number for the city of Bell. We move over to Bell Gardens. This 16 unit sold for $439,000 per unit. That is a sky-high price for Bell Gardens. If you take a look at average values versus what this building sold for, that's a big number. There must have been something really special about that property. But at the end of the day, it only takes one buyer, and that buyer decided this building was worth $7 million. In Cudahy, we have this 6-unit property over on Live Oak that sold for $2.2 million. That's $366,000. Big price for the city of Cudahy. In Huntington Park, we have this 8-unit property sold for $1,575,000 over on Rugby. That's $196,000 per unit. And in Maywood, we have this 8-unit property over on King sold for $2,225,000, which amounted to $278,000 per unit. That is a big, big number in the city of Maywood. Now we want to take a look at vacancy rate and rental growth rate. Why? Because property value, right, is determined in part by the income of a property. So what's the growth rate of rental rates? Now at the beginning of the year, when we recorded our market projection, we projected that vacancy in this corridor would be about 1.4% for the year. We're actually, as of today, sitting at 1.8%, slightly higher, but nothing to be alarmed about. Anything less than, say, a 3% vacancy rate is an average healthy vacancy rate. So that is, like I say, normal for the market. And when it comes to rental growth rate, we had projected that we would see a 6.5% growth in overall asking rents in this corridor. Today we sit at 6.1%, so very close. Of course, we have the remainder of this year to see how much rental rates will grow. Now, the East Los Angeles corridor. This corridor we cover Boyle Heights, East LA, and El Sereno. So when we take a look at those three areas, all the sales that have occurred for the first 6 months of 2022, the total sales volume has been $18,600,000. Well, what does that mean? Well, when you compare it to some of the other corridors like the San Gabriel Valley and so forth, not as many sales as that corridor, but a healthy first half of the year. The average price per unit has been $205,000 on average, and the average cap rate has been 4.54%. Now, when it comes to current asking rents, you can pause the video here and find what unit you're interested in what area. But say in Boyle Heights, a studio on average right now is at $1,257, whereas a 2-bedroom is about $2,000. If you move over to East LA, a studio is $1,194 on average, and a 2-bedroom is $1,911. Now I realize that rarely will you see an ad for a 2-bedroom apartment at $1,911. Keep in mind, these are average asking rental rates between Zillow and Rent-A-Meter. So you just round it off and call that, say, $1,900. So these are your average asking rents for the area. Now, for the highest sale that we wanted to notate in this corridor, we take a look at this 7-unit property that sold in East LA on Simmons, sold for $250,000 per unit. Now, that's a very high price per unit, even if we go back 2-3 years. And the reason why I mentioned that specific time frame is because over that amount of time, LA County Unincorporated has instituted their own rent control and essentially their own eviction moratorium. Over the last 3 years or so in this corridor, you have not been able to raise your rents, not $1. And even here in 2022, you cannot raise rents at all. And the Board of Supervisors have said that you will not raise rents the remainder of the year. They'll take a vote at the end of the year and decide will they allow you to raise rents in 2024. So that has impacted the market where we saw values on the decline as investors sought out investments anywhere else where you could still raise rents, right? Even though there's rent control through the entire state, nonetheless, you could raise it something as opposed to here where you can raise it nothing, unfortunately. So this sale on Simmons was very high, uncharacteristic for the area. But as I understand it, the property also had been rehabbed. So the buyer must have found value in that. Now, when it comes to vacancy rate, and the growth rate of our rental rates, For those of you that watched our video at the beginning of the year, we had a projection that vacancy would be about 1.4% in the East LA corridor. It actually is 1.8%, a little higher than we had projected. And that's nothing alarming. Anything less than, say, 3% is average for a market. So again, in other words, vacancy is very low. Many of you probably experience no vacancy in your buildings. And then when it comes to the growth rate of rentals, we had projected that we would see an overall rate of 6.5% this year. Currently, we're at 6.1%. Rental rates have grown, asking rental rates have grown 6.1% this year. We still may get to that 6.5% projection. Of course, we have another 6 months to go. Now, the Pasadena Corridor. Here, we bring together Pasadena, Sierra Madre, South Pasadena. Why? Because rental rates on average are about the same. Tenant base is about the same. Property values are roughly about the same. So we lump this together in one corridor. For this particular corridor, thus far this year, there's been $77,533,000 worth of sales transactions. That's a healthy first half of the year. And the average price per unit is $355,000. The average cap rate is 3.6%. As we look at rental rates, you can simply pause the video here, find the city and type of unit you're most interested in. To give us some idea, say in Pasadena, the average asking rent for a studio today is $1,760, a one-bedroom $1,988, a two-bedroom $2,566, and a three-bedroom $3,103. Now I realize if you go on, say, Zillow today, you're not going to see a three-bedroom apartment listed for $3,103. These are averages between Zillow and Rent-A-Meter, so you can just round that off and say it's about $3,100 today, say versus a three-bedroom in South Pasadena that's at $3,190 today. Some of the highest sales from this particular corridor, we had this 5-unit property that sold in the city of Pasadena over on Oak Knoll, sold for $2,580,000, $516,000 per unit. That is a healthy price for the corridor. And we also had this 8-unit property that sold in South Pasadena on Huntington Drive, sold for $4,680,000, which amounted to $585,000. That is a big number for the corridor. Shows things are going well there here in South Pasadena. Vacancy rate and rental growth rate. At the beginning of the year, we had projected that in this corridor, we would see a vacancy factor of about 2.3%. Where it stands today is we're actually at 2.4%, just slightly higher, but nothing to be alarmed about. A healthy average vacancy rate is, say, 3% or less. Many of you that own in this area probably have no vacancies at all, so that is a good sign. When it comes to rental growth, we had projected that in this area we would see a growth rate this year of 5.9%. We actually have seen rents grow by 6.7%, far exceeding that projection that we had. The Inland Empire West. Now, in this corridor, we grouped together Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, and the city of Upland. Now, why do we group these particular cities together? One, of course, because of their geographics, but two, because the average tenant base, rental rate, and property value is very similar within these particular markets. So that's how we build out this particular corridor. Now, the total sales volume that has occurred January to June of 2022 in these cities is $62,147,000. So a fair start to the year. The average price per unit, $261,000 per unit. Now that's a big number, especially for those of you that have owned in this particular market for some time. You know that, just say 10 years ago, things were $120,000 per unit. So, definitely growth here in the Inland Empire. Average cap rate for those properties that have sold has been 3.98%, less than a 4% cap. That's very impressive because when you look at many corridors that I work in, say, LA County, those corridors are already at a 4% cap or higher. Here in the Inland Empire, we're actually still below a 4 cap. And that's because a lot of money has come and invested in the Inland Empire, driving up the property values faster than the rental rates can keep pace. Thus, for those buildings that sold, the rental income was on the low end relative to the final sales price. Now, when it comes to asking rents, you can simply pause the video here and pick your city of interest and find the unit type you're looking for. But in general, let's say in the city of Pomona, the average studio asking rental rate is $1,538. The average one bedroom is $1,751, two bedroom $2,115, and three bedroom $2,578. Now I realize that if you go on Zillow, you're not going to find a one bedroom apartment advertised for $1,751. These are averages between Zillow and Rent-A-Meter, so you can just average that off and call it $1,750. But nonetheless, I imagine for many of you, as you take a look at this chart, these rental rates are significantly higher than you would have guessed or assumed, and that's because rents overall here in Southern California have been on a growth path, but particularly here in the Inland Empire where we've seen historic rental growth. Now, to take a look at some of the highest sales within some of these cities, to give us an idea of, well, just how aggressive have property values been this year. I recently sold this 17-unit property for a client in the city of Claremont. That sold for $5.3 million. That amounted to $311,000 per unit. Big number, even for the city of Claremont. In the city of Montclair, 5 units sells for $1,427,000. That's $285,000 per unit. Big number for the city of Montclair. Pomona, 10 units over on Kingsley, sells for $2.5 million. That's $250,000 per unit. Not a huge number for Pomona, but for this particular part of the city, I would say that that's a big number for the city of Pomona. And in the city of Upland, 6 units on Arrow Highway sells for $1.8 million, $300,000 per unit. Definitely an aggressive price for the city of Upland. Now we want to take a look at vacancy rate and rental growth rates. Why? Because property values are tied to rental income, or at least the value is due in part to the income that it collects. And so to begin with, vacancy. Now at the beginning of the year, if you watched our video that we recorded with projections for the year, we had projected that we would see a vacancy rate here in the western part of the Inland Empire. 2.9% was the projection. Vacancy actually is now hovering at 3.8%. Definitely much higher than what we would anticipated, and higher than what I would say is a healthy average. A healthy average is about 3% or less. What's the cause of the recent increase of vacancy? I'm really not sure, because during the pandemic, 2020, 2021, a lot of individuals moved from LA County to the Inland Empire. That's what really drove the rental rates at such a fast pace. And yet here we see vacancy climbing, just something that we have to watch. Nothing to be alarmed about, just something to keep an eye on. Now, annual rental growth. We had projected 6.9%. What we have actually experienced this year is a growth rate of 7.5%, significantly higher than what we had projected. Inland Empire East. Here we bring together Bloomington, Colton, Fontana, and Rialto. Now, why do we bring these particular communities together? Number one, because of their geographic location. But number two, on average, the tenant base is very similar, asking rental rates are very similar, and property values are very similar. Total sales volume. Now, the Eastern Inland Empire has never had a huge sales volume in any particular year. It's been steady. And this year shows about the same. Thus far, from January to June in 2022, there's been about $22 million in overall sales volume, about average what we would anticipate for the area. What we wouldn't anticipate, though, is an average price per unit of $220,000. That's a big number considering where values were just, say, 4-5 years ago. So values have definitely increased in this market. And the average cap rate, again, not what you would expect, 8.1%, meaning that the properties are selling at values significantly higher than the rental income that they're collecting, which really means in the end that investors are willing to take a lower cap rate because they see opportunity in the Inland Empire. Now, when it comes to asking rental rates, you can simply pause the video here, look at the city of interest to you, the unit type you're most interested in to get an idea of what the average asking rental rate is. But for example, in the city of Fontana, the average asking rental rate for a studio, $1,200, a one-bedroom, $1,502, a two-bedroom, $1,820, and a three-bedroom, $2,337. Now I realize that if you were to go on Zillow, you wouldn't see a one-bedroom apartment listed for $1,502. These are averages, again, remember, between Zillow and Rentometer. So you can just average that off and say, well, about $1,500 for a one-bedroom. But I would guess that as you take a look at this chart, these rental rates are significantly higher than what you would have assumed, especially if you've owned in the area for some time. And that's all a positive note for apartment owners. Now, some of the highest sales that we've seen in terms of, to give us an idea, well, how aggressive have prices got in some of these cities? In the city of Colton here recently, 11 units on G Street sells for $2,085,000. That's $189,000 per unit. That is a big number for the city of Colton. In Fontana, 36 units sells for $11,750,000, which amounts to $326,000 per unit. That definitely is an aggressive value for the city of Fontana. And in the city of Rialto, 7 units on Lilac sells for $132,000 per unit, about on average with what you would expect, but that is the highest sale that we've seen in Rialto this year. Now we want to take a look at vacancy rate and rental growth rate. Why? Because this is important when it comes to property value. Property value is tied directly in part to the income that a property receives. So we want to know exactly how much have rental rates grown and what vacancy rate are they competing against. At the beginning of the year, we had recorded a video with projections of what we thought we would see vacancy rate, rental rate this year. We had projected that the vacancy rate would be 2.2%. Where we sit today currently is at 2.5%. So about on track with what we had anticipated for this part of the market. Now, when it comes to rental rates, this is what we did not anticipate. We had projected a rental growth rate of 7.7%, and that would have been a historic number. And yet, we've seen this year thus far a rental growth rate of 8.8%. That is a huge gain in asking rents for any corridor. So you may be asking yourself, well, what does that information mean to me in my real estate portfolio? To answer that question, we would have to know, well, what's your real estate portfolio worth today? So that we could ascertain, well, how much equity, net equity, do you have within your real estate portfolio? To then tell us, well, what's your rate of return on that equity? So then we can determine what opportunities exist for you in the market today, given market dynamics as they are, like we just covered, so that you could move what I call your financial legacy. So you could move that financial legacy in a positive direction for the remainder of the year. I'd be happy to assist you in that analysis. That's much of what we do day to day for our clients. Of course, we don't sell properties all throughout California. We only service certain corridors. Of course, we service your corridor that we've covered market data for here today. And we also will have a link here to the other corridors that we service here in Southern California, LA and San Bernardino counties. I would encourage you to watch those videos just to brush up on what's taking place in the other corridors, but that'll give you some sense of where can we best help you. I would, again, just encourage you to contact our office. We'd be more than happy to assist however we can, whatever information would be helpful to you. Now, second, you may be asking yourself, well, where is the multifamily market headed from here? To answer that question, I would direct you to our YouTube channel. Over the last couple of months, I have interviewed individuals from the space of real estate law, real estate taxation, market forecasting, and capital markets. The reason why it takes those 4 areas is because those 4 areas all are going to impact what happens to multifamily going forward. It's not just a matter of economics. Right now, there's an eviction moratorium in LA County. That has a bearing on values in the multifamily market. The rent control continues to tighten. Certain cities are entertaining, implementing their own version of rent control that will have an impact on the market. Single-family residential real estate is going through its own cycle. Its interest rates have nearly doubled over the last month and a half. That has an impact on multifamily properties. So one has to understand what's taking place in these four various areas to be able to answer what happens next for apartments. I would direct you to those interviews. Now, if you found this information helpful, informative today, I would encourage you to subscribe to our YouTube channel. We have hundreds of hours of educational content, all for free, no sales pitch, on that channel to help landlords like you not just survive multifamily ownership, but to thrive. That's what this is all about. And so I would encourage you to subscribe to our channel. And if you happen to own in our area of service, attend our next live educational event. This is where not only do we cover some of the information that I covered today, but I bring some of the brightest minds together from the commercial real estate space to update the landlords. What's changing when it comes to real estate law, real estate taxation, when it comes to the capital markets, everything in between. And you, as an attendee, get an opportunity to ask the panel of speakers questions with respect to your personal portfolio. We keep the venue small and intimate so that the landlords, the attendees, have an opportunity to engage the speakers, to ask questions with respect to your investment strategy. It is the best thing you could do for your real estate portfolio. So I would invite you, encourage you, when you see the next announcement for our educational luncheon, that hopefully you have the opportunity to attend. With that, Chris German from the Apartment Dealer, wishing you, as always, positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.